Okay, let's dive right into this explainer and run the real math on the ultimate financial debate. We're talking about buying rental properties versus investing in the stock market. We constantly hear both sides claiming, absolutely guaranteeing they have the absolute best way to build wealth. So today, we're visually breaking down exactly what happens when you put these two assets head to head.
Both sides guarantee you'll get rich, right? But the actual truth? Well, it's hidden in the time costs, the missing zeros, and a brutal 20-year timeline. We are stripping away the emotions, we're ignoring the catchy headlines, and we're just going to watch the numbers grow. Let's see who actually gets richer.
Meet our two investors. Same age, same city, same $55,000 salary, and most importantly, they each have exactly 50 grand saved up. Now Jake, he uses his 50 grand as a 20% down payment on a rental house. Marcus, on the other hand, drops his 50 grand straight into an index fund, sets up a $300 automatic monthly contribution, and just walks away.
On day one, things look incredibly lopsided. Jake has a physical, tangible house. He's got a tenant paying him $1,800 a month and a really awesome story to tell at dinner parties. His mortgage is about $1,330, so he's collecting rent that covers his 7% mortgage, leaving him with a $470 a month profit on paper. He's feeling like an absolute genius.
But what's really interesting here is that this $470, that's the number everyone brags about at barbecues. It's the number you see plastered on flashy thumbnails. But honestly, it's a complete illusion of profit. It just totally ignores reality. Because behind the scenes, Jake is getting hammered by hidden costs. I'm talking property taxes, insurance, a $1,200 water heater that just blew up, $2,800 for a leaking roof, and then a month of vacancy costs him $1,800 in lost rent. By trying to manage it himself, Jake didn't really save money. He just took on an unpaid, super high-stress part-time job. And this perfectly illustrates the real estate trap. When you actually subtract the taxes, the insurance, and the maintenance, Jake's impressive gross income shrinks to a tiny net reality. Over 3 years, he expected nearly $17,000 in cash flow, but his actual, real-world profit? A mere $2,000 to $4,000. Meanwhile, check in on Marcus. He hasn't taken a single emergency phone call or fixed a single overflowing toilet. His completely passive index funds have quietly grown to $76,000. Zero stress. But, to his friends, he has nothing physical to show for it, just a boring number on a screen. But don't count Jake out yet. He still has a massive advantage working in the background called leverage. This is literally the financial superpower of real estate. Leverage basically means his initial $50,000 is benefiting from the appreciation of a $250,000 asset. The bank put up the rest of the cash, but Jake gets to keep 100% of the property's appreciation. It's an insane advantage the stock investors just cannot easily replicate. So, let's fast forward to year 10. Surprisingly, they are neck and neck. Thanks to the bank's money multiplying his gains, Jake's total equity is sitting around $180,000. But Marcus, just steadily investing his boring $300 a month, is right there with him.
However, that slight lead cost Jake dearly in out-of-pocket expenses. Over a decade, Jake poured another $20,000 to $35,000 of his own cash into the property. A completely new roof, constant plumbing emergencies, and literally hundreds of hours of his personal time. Worse, his money is entirely concentrated in a single asset, stuck in a single zip code. Over on the stock side, though, we see the magic of compounding really taking over. Now, compounding starts out incredibly boring for the first 5 years. It feels like you're going absolutely nowhere. But just watch this curve. It becomes astonishing. The gains on Marcus's gains start generating more new wealth each year than his original monthly contributions. He has diversified across thousands of companies doing absolutely nothing.
But let's be real, stocks aren't perfect either. We absolutely have to look at the brutal volatility. Think about the gut-wrenching 37% market crash in 2008, or the 34% drop in 2020. Watching your life savings plummet by 50 grand in a few weeks? That isn't just a number on a screen. It is absolutely terrifying.
Marcus has to stomach these massive drops without panic selling, which data shows us most everyday investors completely fail to do. Plus, he gets virtually zero usable cash flow today. A total market fund might yield a tiny 1.5% to 2% in dividends. He doesn't have the bank's leverage multiplying his money, and his gains, zero shelter from the taxman.
Speaking of shelters, Jake gets a really unique benefit here. He can legally deduct the theoretical decline of his building's value on his taxes. It's called depreciation. So, Even if his house is actually going up in value in the real world, he's shaving thousands off his tax bill every single year on paper. This is a powerful, legal tax shelter that Marcus simply cannot access.
Okay, let's fast forward past all the turbulence to the 20-year mark. This is the ultimate finish line for our explainer. At this point, Jake's mortgage is nearly paid off, his property value has significantly increased, and Marcus's compound interest curve, it is gone fully exponential.
So, what's the verdict? After 2 long decades, they land in the exact same ballpark. Yeah, Jake is sitting on roughly $500,000 in equity and cash flow, but Marcus's original $50,000 plus his boring monthly contributions has exploded to around $450,000. It is practically a tie.
But, and this is a huge but, the quality of that wealth is vastly different. It all comes down to liquidity. Marcus has total liquidity and freedom. He could click a button and have cash in his checking account in days. Jake, on the other hand, has a highly concentrated, illiquid asset. His money is literally trapped inside drywall and lumber in one specific neighborhood.
In short, Jake worked for his wealth through stress, debt, and, fixing toilets at 2 a.m. Marcus, he waited for his wealth through extreme patience and stomaching terrifying market crashes. Jake took on debt, Marcus embraced liquid freedom.
Now, here is where the math dramatically changes. If Marcus had just increased his automatic contribution by a mere $200, bringing it to $500 a month, his portfolio would skyrocket up to over $550,000, potentially pushing $600,000.
In the stock market, increasing contributions multiplies effortlessly through compounding. It takes, 30 seconds to change a contribution setting on an app? Whereas for Jake to scale his returns and match that jump, he can't just click a button. He would have to save up for another massive down payment, buy a whole second property, take on hundreds of thousands in new debt, and literally double his stress and workload.
All that said, real estate absolutely wins if you leverage specific strategies. Like, it wins if you house hack, living in one unit and renting out the others to drop your own housing costs to zero. And it definitely wins if you use legal loopholes like 1031 exchanges to roll your profits into bigger buildings entirely tax-free. But you have to treat it like a rigid, professional business. Ultimately, both Jake and Marcus made some big assumptions at the starting line. They fell into the trap of picking an asset class based on social media hype rather than sitting down and running their own personal math for their specific situations. You have to account for the time, the stress, and all those hidden zeros.
So you have to look closely at these two paths and ask yourself, do you want to be the worker dealing with tenants, toilets, and the incredible power of leverage, or do you want to be the waiter, doing absolutely nothing but riding out terrifying market crashes for ultimate liquid freedom?
We've spent this entire explainer treating this as a strict either-or scenario, but I'm going to leave you with this final provocative thought to ponder. What happens to the math, the risk, and the compounding growth if you buy real estate and consistently invest in index funds at the exact same time? That is where the wealth equation truly gets fascinating.